Welcome to this conversation on the role of banks and financial institutions on decarbonising our economy. We're incredibly privileged today to have an amazing group of thinkers on the topic. We have Alex Mickey, head of the Glasgow Alliance for Net Zero. We have Lisa Pretorius, head of sustainability analysis at the sustainability analytics firm Matter, and formerly VP of climate finance for the WWF Southeast Asia. And Nils Madsen joins us, head of group sustainability risk at Danske Bank and formerly head of group impairment. So in my own opinion, some absolutely amazing thinkers on the topic, and we just want to dive straight in. So Alex, I'd like to start with you. I think to the observer of sustainable finance, there's been a massive shift from Paris and talking about the 2-degree targets to shifting towards 1.5, and today a prominent discourse amongst many financial institutions that we must reach net zero, that we must have net zero targets. Now, Alex, your organisation, you're sort of right at the crux of this issue. You've worked sort of with banks to set these targets, and you played, I believe, a defining role at the COP26. Walk us through this process. What was it like to get here, and what might not be obvious to the public in this shift? Put us on the floor.
Thanks, Nicholas. Very kind. So I think in Paris, which is obviously the defining COP where world governments came together and committed to keep global temperatures below 2 degrees, the intervening period between Paris and Glasgow, the science unfortunately became clearer and more emphatic that some of the tipping points that create irreversible, and that's the really important bit, irreversible and catastrophic climate change happen closer to 1.5 than to 2 degrees. And the IPCC suggested that, which is the government scientists, the global government's leading scientific body, that in order to have a 50% chance of limiting global heating to 1.5, we need to have a net zero global economy by 2050 at the latest. And that means that not only do we have to massively start reducing our carbon emissions essentially from today, because what matters is our carbon budget. So it's not just hitting net zero 2050, it's actually decarbonising from very soon, and hitting 50% decarbonisation by the end of the decade. But we then have to, the residual emissions, which will inevitably be there because of the kind of size of the population the economy will have in 2050, will need to be permanently removed. So the big shift between Paris and Glasgow was a really renewed focus on 1.5, and further, as you suggest, a commitment to hit net zero by 2050 and start that decarbonisation journey today. And that's why you saw, when the UK took the COP presidency 3 years ago, there was about 15 to 20% of global emissions were covered by net zero targets, and by Glasgow it's about 90% at state level. But I think another innovation that you saw in between Paris and Glasgow was the realization that we're not going to get to 1.5 without a whole of economy, whole of society approach. So COPs are obviously led by global governments, but I think Glasgow put also civil society and the private sector and the financial sector right at the heart of the negotiations and the outputs and the achievements of Glasgow. So taking the financial sector, which is where I was working, we were led by Mark Carney, who was appointed the Prime Minister's finance advisor for COP26 and UN Special Envoy for Climate Finance. He realised that we need the entire financial sector working together to achieve net zero. If we take 2 years ago, there wasn't a single bank that was committed to the UNFCCC's guidelines on net zero commitments in the race to zero. And what that means is they commit to be net zero by 2050, but they also publish 2030, really important, near-term 2030 targets, science-based targets, and report their progress against those targets every year. So there wasn't a single one. By Glasgow, there was 100 banks committed to net zero. In the Glasgow Financial Alliance for Net Zero, we have over 450 members whose combined balance sheets total more than 130 trillion, 45 countries. So you really, as you said, you've seen this huge shift of the majority of the, particularly Northern Hemisphere, financial system commit to net zero and join this alliance. And now I think if those commitments are implemented, we will bring forward a 1.5 degree world. So the focus now has to be on making those commitments real and implementing them. And that's what a lot of our work this year is now focused on.
Very exciting. Alex, I want to return to you and what you think was sort of the tipping point, what drove banks to make these pledges. But first, we have Niels here, and from the Danske Bank point of view, I mean, Danske Bank was one of the early adopters to this framework, and has signed up. So what does it look like from your side? Perhaps both, why did you choose to commit, and also your sort of what are the next steps, the implementation plans, etc. from your point of view?
Yeah, so I think I'm very happy to hear this framing. It very accurately describes the journey that we've been on as well. We have signed up, we're a universal bank in the Nordics, so we really have a footprint in many ways. We've signed up to the net zero pledges, both as a bank, as an asset manager, and as an asset owner. So we really have a lot of links into this ongoing work, and I greatly appreciate the collaboration on this. So I think for us, and I can speak mainly to the lending side, which I'm directly responsible for, of course, there is this discussion about data. How much can you say about your footprint? How much can you say about transition plans? And this is certainly a challenge we share. We've been working on a data foundation for this for the last couple of years. And I think what has really happened also after Glasgow is an acceleration of our efforts to say what we can say. There are plenty of unknowns, but I think we've gone from wanting to set targets on the entire loan book to really starting to get moving on the key parts. And we really found that for our financed emissions, a relatively large share comes from a few industries and actually from a few customers. So that insight that we gained over sort of the last year or so allowed us to come out with targets, 2030 interim targets in January of this year. We have also launched a new purpose for the bank, where this is a quite key part of it, both in our product advisory and risk management practices. But it basically culminated in 3 targets, one for the oil and gas industry, which is sort of more of a reduction target. We obviously need to see less financing going forward of pure play oil and gas. But then the 2 others are, and I think this is the journey we've been on, the 2 others relate to shipping, which is a very large part of our carbon footprint, being in the Nordics with a proud shipping tradition. And then the utilities book, so the heat and power generation in particular. And the targets we've set there are not just reduction targets, they're intensity targets. So they recognize the need to redirect capital to the efficient customers, to really deeply understand their transition plans and to really engage in the dialogue, but then of course be okay with a short-term accounting increase in financed emissions or some short-term fluctuations in data, because we understand and engage with the customers in a way where we know that the 2030 target will be met. And I think that has really been a game changer, both in terms of structuring this from a management level, but also in terms of integrating it. That is very practical for the senior banker. Talking to that particular customer, they can look at the technology mix, they can have a deep discussion with the management, and they can really gauge whether this is a sufficient transition plan or not. And I think that the final thing we found is that really requires that you understand the sectors you're in. There is no one-size-fits-all framework for that part. You need the sector-level expertise, whether they are shipping experts who need to understand the fuel mix, how to source this going forward, efficiency measures, or whether they're utilities, where we've started to hire actually engineers and people who are much more into the technology mix and concrete capex of the customers. So I think it's really gone from being very commitment-based, something on a very high level, to being sector-specific and to becoming integrated into the credit decisions. And I think that has been the journey for us, and I think it's allowed us to prioritize and in fact start with what is a very concentrated set of customers, which makes us very, very concrete. And I think that has been very positively received in the organization. It brings it to a concrete and specific level, and it basically goes into your daily work. Now, we have lots of data challenges and gaps and things we need to resolve, also as an asset manager, also for our private households. We have a large agriculture land use challenge in Denmark as well. So it's not to say that everything is solved by looking at those large counterparties, but we can get a very, very long way. And that has been the focus, which will now start to shift more to the mass market customers as well.
So I'm hearing that the need for decision-making data when driving investments is obviously at the heart of this problem, and taking the early steps. And in your case, the particular exposure to large players means that the ability to take a case-by-case basis, bring on experts, and make an assessment is possible. Lisa, Your company represents the perspective that I believe enables more of the asset management side of this question. So making decisions across large portfolios to figure out what is the exposure. Can you tell us a little bit more about both your approach and perhaps some of the problems that you see and how you're bridging this big data gap?
Yeah, absolutely. So, I mean, it's a really good point you make, that the type of deep expertise that you need to have a real understanding of whether a company in a given sector is on its transition path that is required for a given sector. You know, you have the chance to go deep with some of these companies. You have expertise that can understand the technologies, whether the management has the right vision, the right expertise, the right incentives in place, and indeed whether companies are actually making progress on these targets over time. This is ideally the type of data we have at scale across all companies, across all sectors, and of course that's a big data challenge because it's not always there. So this is what we're trying to solve at Matter, and basically trying to bring in data from a variety of global sources that are experts in their own either issue or sector. So when we're thinking about, for example, either decarbonization or something like land use change and deforestation, which is also a huge part of net zero transitions, it's not necessarily up to us as Matter and our analysts to decide what is the transition plan required of certain sectors. So we would rather listen to, for example, a WWF or a ZSL or a Global Canopy, work with them to understand the expectations they have of companies and they have of sectors and how companies are doing in this regard, and integrate their data, basically linking all of these insights to ISINs, and then investors can screen their portfolios with us and be linked to these insights. And the idea is really to, instead of kind of relying on privately defined and privatized notions of sustainability and transition plans, which is really where the ESG world has come from in the forms of ratings, we're moving towards this idea of science-based and multi-stakeholder definitions of sustainability, which is really also, I think, a lot of the work that you guys are doing, saying we need standards, we need frameworks, and we need everyone to be singing from the same hymn book. So the challenge we're trying to solve really is then how do we populate that with data so that we can all understand what is the transition required for the building sector, for agriculture, for energy, for transport, and really then get that integrated into not just asset managers and asset owners, but banks, insurers, brokers, advisors. We all need to, they all have different levers in the finance sector linking to the real economy, but those levers need to be pulled singing from, pushing the same expectations of companies and tracking the same sort of KPIs over time. That's really the only way that we'll get to net zero.
Yeah, I completely agree with that. And I think just to reiterate a couple of the points that both Niels and Lisa made, one, I like the point Niels made, which is like data is an issue, but that's no reason not to act now. And we're seeing a lot of our members acting now, setting interim targets and not just at a portfolio level, but at a sector level. I think that's really important because one of the easiest ways, and this again speaks to the data issue we were just talking about, but one of the easiest ways for an individual institution to reduce their finance emissions might be to pull out of some sectors and into others, and specifically from industry to services, but that won't actually provide the economy with the investment and the finance it needs to decarbonize. We need a huge increase in investment in the right types of investment to decarbonize industry, energy, steel, cement, aviation. These are industries that are always going to be with us and we're always going to need them, but they need the finance to decarbonize. But we need much better frameworks, guidance, regulation, data to ensure that that finance is indeed supporting decarbonisation and not just business as usual. The point that Lisa made is a really good one and goes to the heart of what the Glasgow Financial Alliance for Net Zero does, which is we need a whole of economy approach, but we also need a whole of financial sector approach. And where we started at COP26 with our finance strategy was climate needs to be at the heart of every professional financial decision. And obviously banks are a huge part of that and asset owners are a big part of that. But actually there's a really big financial ecosystem where that is incredibly influential for how capital ultimately gets allocated and how those financial decisions are actually made. So stock exchanges, credit rating agencies, auditors, indexes, benchmark providers. And we've created a financial services alliance for net zero, and it's trying to create a level of ambition that's commensurate with the banks. So, for example, before GFANZ came around, banks were making net zero targets, which was just on their scope 1 and 2 emissions, which is like, are there buildings renewably, are there people getting to work in a renewable way? That's typically less than 0.1% of their finance emissions. So how they actually make their money, what the business they do, the lending decisions, the underwriting decisions. But for financial service providers, what does that mean? I think it means that the indexes they provide are supporting the transition, the benchmarks they provide are supporting the transition, the exchanges, the listing rules, etc., are supporting the transition to net zero, so that ultimately we have the data and the incentives we need for this huge capital allocation issue to be solved. And I think data will play a really important role in that. But it requires, asset owners, asset managers, banks, index providers working together, including with the official sector and customers and the real economy. And that's what we're trying to engineer, is that radical collaboration that hasn't always been there to align the whole financial system to net zero.
So, do you mind if I weigh in here?
I was hoping you would.
It's a really interesting point, and something that's becoming quite frustrating, actually. We see many net zero commitments that are only covering scope 1 and 2, and for financial institutions, I truly don't think that this should be flying these days. And so we see a situation where Marsh, for example, huge insurance broker with really a lot of global power in terms of the projects that it will support, and now stepping in to be the broker for the East African oil pipeline, when many global banks and Munich Re has said that they won't either lend or insure this project. It's an absolute climate disaster. It hasn't followed free, prior, informed consent principles with the communities that would be displaced. It's going to be traversing wildlife across the whole region when we're in the middle of a mass extinction, huge impact on water resources, etc. It's a hugely controversial project, but they're allowed to be involved in it because their net zero commitment does not cover basically any of their activities other than just their own operations. So it's basically allowing leakage, both within financial institutions, but also across financial institutions, when the same sort of rigor and expectations of what a net zero commitment means aren't applied across the board.
Yeah,
I think it just shows you, as a bank as well, you need to have the leverage across the value chain.
Yeah.
So I think we're increasingly moving into both the personal household mortgage space. We're moving into small and medium enterprises who typically are not able to report to the same extent, don't necessarily have the same expertise here. But you really see the fact that we're a universal bank. We have the small and medium corporates, we have the large corporates. You're part of the same value chain. You're part of the same scope 3 commitment for a large corporate if you're providing parts or a sub-supplier. And that, I think, is increasingly what we're finding, that we can leverage that. Farmers, for instance, in Denmark, there are a lot of positive initiatives being taken to get better data on this, to support the government's climate plan. But ultimately, the reporting obligation is quite big for an individual farmer to lift. But then you have the cooperatives, basically who buy all of these agricultural products and put them to market. They have their scope 3 targets. They have their science-based targets commitments. So they have their own certification schemes and their own reporting obligations for their farmers. So how do we as a bank tap into that? And how do we make sure that somehow we capture the same data that they capture? That allows this to be not just a collaboration across the financial sector, but also with the larger organizations in the real economy. The same with shipping, where we're signatory to the Poseidon Principles, which is an attempt to do vessel-level reporting on the ships, so we have a very granular understanding of that. Those types of initiatives, I think, will be absolutely key. And they will make sure that even if some parties don't sign up to their own scope 3 emissions, it will be very, very clear when the value chain that they're nevertheless having a negative impact. This is the challenge for us. Again, I think it has to be sector specific. That's what makes this so difficult. There are a ton of things you can do generically, but for something like shipping, you need ship-specific indicators. For agriculture, you need something that very clearly allows you to identify milk producers and how efficient they are. So that's on the one hand the challenge. On the other hand, it's something you're used to dealing with. It's sort of similar to the underwriting assessment you do to a milk producer. How efficient are they already? Are they investing in modern technology. Now you just need to integrate the sustainability aspect. But there is something that we're grappling there on the data side with how to capture the SMEs, but maybe try to capture them through the large corporate value chain.
And
Go on.
no, so I was going to say that I think that the competition between certification schemes and like the risks of obviously a race to the bottom on standards is an old-standing problem, and we see it from corporate sustainability as old as before the term itself. You talk about a few standards here, Nelson, and an obvious thing I didn't hear you mention was perhaps the work of the EU on the taxonomy. Now, the taxonomy was originally intended to create this standardization for the particular purpose of also helping banks actually make these final calls. Are you optimistic about the taxonomy and what's coming?
I think I'm optimistic about the ecosystem. So if you take the taxonomy, if you take the corporate sustainability reporting directive, if you take the due diligence directive, I think that creates an ecosystem where large corporates in particular has a very, very strong reporting obligation, a very strong board level liability and anchoring of this. And I think that in itself creates also a real economy impact. You are going to have, it's very difficult to dodge out of that responsibility. Now, the taxonomy, specifically for me and the lending side, we will always have an in-depth conversation with our customers and try to understand their data. But what I think it does is it gives you the forward-looking piece. The fact that you have to report not just on revenue, operational expenses, but on your capital expenditure is extremely helpful for us as a bank. That's ultimately what we will finance. And it forces companies to report in a forward-looking way, which they have never done in a standardized manner, right? We're used to backward-looking financial accounts. I think the taxonomy, the CSRD, pushes you into something much more like a 2030 world and then setting those interim targets. So on the lending side, for me, I think we're a bit different than the asset management business. But for the lending side, it is probably not the exact taxonomy alignment ratio. That's the interesting part. It's the standardized activity level based reporting with a forward-looking element. That's extremely interesting.
Yeah, I'm just picking out on the common thread between those two comments, which is like the need for standardization on what this all means and upward convergence ultimately. I mean, this is with all greenfield new endeavors, you have a lot of innovation and a lot of healthy competition, but ultimately we need to push towards identifying best practices and start creating a more understandable, navigable level playing field for all of this stuff. And I think the UNFCCC's Race to Zero has really helped which is the same for there's no way into the Glasgow Financial Alliance for Net Zero other than joining the Race to Zero. So this is a framework for what net zero commitment mean. That has to cover your scope 3 emissions. I think that is a standard that needs to be adopted around the world. And ultimately, I think, we need to look to regulation to say you actually can't make a net zero commitment unless it covers your scope 3 activity, because it's not commensurate to what people understand a net zero commitment to be. But then on the broader ecosystem, like we had the Task Force for Climate-Related Financial Disclosures, which is just at COP26. We announced the launch of the IFRS's International Sustainability Standards Board. So hopefully with the US, I'm going to go through an alphabet soup here, but the US's SEC has just published a consultation. EFRAG in the EU has just published a consultation. The UK at COP announced that they've launched a task force to think about regulating for net zero transition plans. So I think that glide path from voluntary initiatives, identifying best practice, innovating, finding what works, through to creating global standards like the ISSB, and hopefully ultimately transition plans in a kind of consistent way that delivers that level of ambition and understanding, so that if you're a lender or if indeed you're a customer or you're a household, what, when people say that we're committed to net zero and we're supporting the net zero transition, that is true. And I think we're at the start of that journey, but I do think transition plans will be at the heart of that. So I think if ultimately all public and private companies have to commit to publishing net zero transition plans, we'll see that positive feedback with the data and the financial industry knowing that the lending, and also us as people, our pensions and our savings are supporting the net zero transition that we all want to see and need to see. And I completely agree with Niels that we need a sector-specific approach. We as GFANZ are doing a lot of work building on the Poseidon principles to try and support the adoption of net zero sector pathways for steel, for aviation, for oil and gas. And we'll be publishing some of this in the coming month, in June, as well as our own guidance for what a good quality financial institution transition plan looks like. And I think that will have to be holistic, because if you just use something like financed emissions, as Neil says, it can be backwards looking. And what we don't want to see is portfolio decarbonisation leading to real world increases in carbon. So we actually need that sector specific forward looking approach to augment and complement the finance emission approach to ensure that finance is ultimately flowing to where the emissions are in order to decarbonise them, because that's what we need. But that's a tricky issue, right? We need the high quality data and framework so that financial institutions and customers and civil society can know that finance is actually supporting decarbonisation. It's not supporting business as usual.
I really like this idea, or at least the role of sector-specific transition plans that include Scope 3. Mm-hmm. So for financial institutions, this means your finance emissions or portfolios, but also for companies, financial institutions should be looking at their Scope 3, mm-hmm. portfolio companies or clients, whoever they may be. And exactly would at least in theory, I hope, tackle this issue of a lot of climate-related strategies actually not decarbonizing the real economy, sometimes even increasing real economy emissions. Perfect example is some fossil fuel companies, or say coal mining companies, spinning off their coal assets, now not on their balance sheet anymore. Their emissions or Scope 1 and 2 footprint looks better. But that is now just in a different entity that other financial institutions pick up. And this is a perfect example of not everyone is singing from the same hymn book. Mm-hmm. So Anglo-American in South Africa spun off their coal assets into Tegela Resources, which is now thriving, 1,000% increase since it listed. And State Street, Vanguard, Aberdeen, huge investors really enjoying this, and are major shareholders in this spin-off. So if this is happening, but if Scope 3 can clamp down on this, basically, if everyone needs to take into account Scope 3, these sorts of assets should be picked up and weeded out, essentially, at least in theory, because this coal is someone's Scope 3, right? And that should be covered by a transition plan. But as long as transition plans aren't actively and kind of rigorously covering Scope 3, this will always be allowed to happen.
Mm-hmm. And that is another benefit of the taxonomy. I mean, it is economic activities you need to steer. It is not whatever industry code that a certain company might be under in a reporting regime, right? So having this very narrow scope that we have today in reporting obviously changes. We start doing activity-based reporting also on our lending portfolio, also on our investment book. I think that is extremely helpful. It moves from us having one number in an oil and gas bracket to having a proper activity-based reporting, forward-looking view. Again, it helps a lot in our communication.
So speaking to this idea of what do we do with the bad assets, Alex, I'm fascinated for you to perhaps share a point of view that we had over a beer at a pub in London not too long ago. So your work coming off of the financial crisis in 2008 and sitting at the heart of sort of post-financial crisis management with the Bank of England, you were sharing some thinking about the roles initially of bad banks as carrying and sort of writing off some of these bad assets, and had a perspective on how this might also play a role in perhaps solving this problem. Is this something you could perhaps talk about?
Yeah, well, I think it speaks to the point Lisa was making, which is like, and it is related to this finance emissions issue that we were just discussing, which is if you have an asset that is not consistent with your net zero commitment as a big financial institution, and you divest that, someone else is picking that up. And that can sometimes not lead to actual real world decarbonisation. And there's a bunch of assets that around the world that are owned that are not consistent with a net zero world, with a 1.5 world. So these are sometimes called stranded assets, because if the world gets really serious about 1.5 and says, okay, we can't have activities that's not consistent with a 1.5 world, then a bunch of these assets are going to be stranded. So there's a question of what do you do with these assets? And if they're just divested into the shadows, sometimes they'll just be run in a way that's not consistent. You've seen, as Lisa was referring to, you've seen some of these assets that get divested and then, gas flaring increases. So emissions actually go up, or actually they get expanded. So what we really need to develop is a framework for identifying which assets may become stranded in the future and how to manage those responsibly in a way that is consistent with the net zero commitment of a large financial institution. And also, really importantly, for the communities that actually are impacted by this asset. Some of these assets are in communities that have highly concentrated workforce around coal mining, for example, or energy production. So this, again, as I referred to earlier, is going to require quite radical collaboration between the public and private sectors to understand, okay, how do we identify assets that are not commensurate with a net zero world? And you've seen an announcement at COP26 around a big partnership with South Africa to try and decarbonize their energy system, which is at the moment very heavily dependent on coal. And a framework such that those assets get retired in a responsible way, responsible for the community, responsible for the planet, rather than just push into the shadows where who knows what might happen to them. Sometimes they get run in a worse way than they were previously.
And the collaboration piece required, because otherwise someone's just going to pick it up and enjoy it, right?
Exactly. So we're actually going to be publishing a paper on this as well in June, which is like, how do we develop that framework? It's a financial framework, it's a policy framework, it's that collaboration so that we can all see this asset doesn't get pushed into the shadows, into someone else. It's being run down in a responsible way, in a way that works for the community, in a way that works for climate policy, and in a way that hopefully works for the financial institution as well.
Again, I think the data piece is critical here. I think that you could get a long way with more transparency in reporting. I mean, you have non-core units being set up in other types of financial reporting to manage down assets that are not part of your long-term strategy. I haven't seen that done much for sustainability reasons. It's typically restructuring related or other types of stranded assets. But there is something around transparency of this, putting it on the books. Clearly, this is a rundown activity. I think would be a much more honest way of positioning some of this. And it goes to the taxonomy point again, that if you are able to sort of forecast your balance sheets, show where you are in 2030, what is in line, what is not on an activity level. I think there's a lot of understanding, particularly given the energy crisis we're in right now, that there is a transition, that everything is not a full immediate exit, but it requires transparency, both for us as a bank, but also for our customers to be very clear on what business lines are aligned, not just on a company-wide net zero commitment, but very clearly on the business line, very clearly on what do you understand to be the transitioning part. What today you often see is basically a full support to a business line until it's exited. And of course, there is a market dynamic you have to respect there, but there is something with being more honest in the reporting, which allows you to be a bit more nuanced than these very heavy divestments that suddenly occur. And I think that all goes again to the CSRD, to what EFRAG is working on, this kind of forward-looking aspect. It really would help a lot.
And actually, GFANZ issued a call to action to the G20 just before the summit last year, which actually called for transition planning to be made mandatory ultimately for all companies, so that you have that more sophisticated understanding of what a company is trying to do. And if this is publicly reported on, then you can see if that transition plan is good enough to begin with, but B, if it's being implemented. And so we can continue to finance those companies that are committed to the transition rather than just divesting from them because they're a heavy industry and so they at the moment have high emissions, because as I mentioned earlier, we actually really need to provide finance to heavy industry in order to decarbonize it. But in order to do that, we need better quality transition plans, public transition plans. And I think ultimately that will probably require a level of regulation that we are starting to see, actually, as you mentioned, EFRAG and the ISSB.
This is actually critical, this whole concept of transition plans for companies, but also then for portfolios, because, and I guess this is kind of what the EU taxonomy is doing. It has now started on the green side, but the idea is for it to also include an amber and a red taxonomy. so that it can be clear that certain assets are just, they are red, like we can't be investing in them or funding them, and we have to get out. But then there's a whole bunch that is amber, that does need to transition. And then even within the green sector, there are transition activities which we need to get down to kind of their green standards. And having this kind of, whether it's that taxonomy or other standards, it's good that these are being kind of at least debated and created with sort of intense multi-stakeholder debate, which is good. But then it also means that for financial institutions, they can't hide behind, for example, still holding a bunch of coal assets and saying, oh, it's because I'm transitioning my portfolio in the future, and that means I can still hold coal today and I'll get rid of it at some point. These taxonomies and standards and frameworks allow us to say, well, actually, if you're going to have a portfolio transition plan, what assumptions are you using, what definitions are you using, what frameworks are you using, and how are you making sure that this transition is happening over time, so that, the banks, for example, can't just carry on investing in coal all over Southeast Asia and say, it's because we can still hold some coal, but we're still transitioning. There's some sort of accountability into exactly how portfolios transition.
Yeah, exactly.
And some of it is small things. I mean, this sounds very simple, but we never, before the end of last year, disclosed on a production mix basis our utilities portfolio. So we're trying to be very transparent now around what is the fossil fuel exposure. But it doesn't neatly map into a simple reporting frame. You have to go through customer by customer and map this out. And we've basically done that internally and presented it sort of ad hoc. But just this very simple disclosure. It's one page. It's on slide 35 in an investor deck. But it really has helped create that transparency and anchor that dialogue. And it was a very simple fix. It was an afternoon's work. And I think it was only relatively late we realized that actually was something we'd only given bits and pieces on. There's a lot of things you can do with clear disclosure here. And it does bring forth that it's a very small part of our portfolio and it's declining. But then you have the path, and then you have the transparency. And sometimes we of course know more internally than necessarily we disclose. And again, you shouldn't wait for the perfect FRAC standard to come up. If that is transparency you can help create today, you should basically do it.
And those conversations, I'm hearing this all the time, are really starting between the financial sector, the banking sector, and the real economy. As you started this session about the sea change that we've seen, we're now seeing most of the biggest banks in the world publish science-based targets on a sector-specific level. And that's not their ESG department doing that. Those targets touch every part of the business. So if you set an energy target for, to decarbonize 60% by 2030 on a physical intensity metric, then that's actually your bankers, your lenders, your underwriters who are having those conversations with real economy firms. Okay, well, if for us to continue this relationship, what are you doing to decarbonize your business? And that conversation between finance and the real economy has gone from right to the top of the conversations is what which is what is needed. And it needs to be the top. And that's about achieving ultimately what we set out to do 2 years ago, which is to put climate at the heart of every professional financial decision.
So picking up on this idea of certain assets, because of course every company wants to do an Ørsted, wants to go from being CO2 intensive industry to being a decarbonizing force in the world, but realizing that many can't. Is there a space for carbon credit markets in all of this, or other mechanisms of the kind?
I think there's a lot in your question. There's do we need a carbon price in order to transition to net zero? I think the answer is probably yes, because this is ultimately a huge market failure, and one of the ways you fix market failures is you make sure the price and the externality is priced for. And GFAN's made a call again to the G20 last year to make sure that the external price of carbon is being properly valued and accounted for. So that's a state level action. The other is offset markets. There's state level offset markets, government level, which is part of the COP process. And there was progress on that at Glasgow in terms of what's called Article 6. Then I think you're also talking about voluntary carbon markets, which are sometimes called offsets. The thing I'd say there is that I think ultimately it's really important people decarbonize and mitigate before they turn to offsets. So the net zero journey is about decarbonizing your activity, your portfolio. It's not about buying offsets, and that's quite clear in the Race to Zero criteria. but we will get to these residual emissions, right? Where in 2050 there's going to be emissions, and they need to be removed, and we need finance to flow in the meantime to protect forests and mangroves around the world, and we need uneconomic investment in carbon capture technologies and carbon removal technologies. So how do you incentivize that? And there's a couple of innovations, the Voluntary Carbon Markets Initiative, Integrity Council, so that these initiatives to create the reason they've been set up is because historically offset markets have been quite bad. There's been some fraud in it. A lot of investigations into it have shown that the offsets that are being bought aren't actually going and removing carbon from the. But that's not to say historically they've been bad, that we shouldn't do them. Absolutely, they're going to be absolutely crucial to ensuring that finance flows to the Amazon to protect the Amazon or protect mangroves around the world, which we're going to need to limit to 1.5. So those markets are going to be really important. And I think we have a work stream on mobilizing capital to emerging markets and developing economies. We need huge investment flows. We need huge increases in capital, both equity, all different types of capital, right? Not just debt, flowing to emerging markets to finance their energy transition, but also to protect their natural biodiversity and carbon sinks, because a huge portions of our carbon sinks are actually in those countries. And I think offset markets, carbon markets, high integrity carbon markets will play an important role in mobilizing that capital to those natural habitats.
Yeah, I couldn't agree more on the high integrity, and I guess where your question comes from is that carbon markets, at least somewhat now, are kind of a wild west, as they were in the early 2000s. And yeah, I completely agree. So if we link it back to the carbon price, also we do need a higher carbon price to incentivize some of the things that need to be in place to make sure that projects are actually, keeping carbon out of the atmosphere permanently. Do include communities into these projects and make sure that they're co-benefits. All of these sorts of things need kind of a certain carbon price to be viable. Otherwise, they're always going to be dependent on kind of blended finance approaches or other mechanisms. And it would be ideal if the market kind of worked for itself in this sense. But absolutely, like I think there has to be a role for these. I think you made a perfect point that firstly they need to be good projects, and there's a lot of work going on, which is great. And I also completely second your point that we can't just allow offsets to be bought for everything. It's almost like companies need to first prove somehow. It should be like you have to apply to be able to use offsets as part of your net zero plan. Once you've proved that you've actually done everything you can to mitigate, because at the moment that's not always the case, and there's not this sort of there's not necessarily a very strict focus on making sure that mitigation does happen first before offsets come into the picture.
Yeah. I mean, the Science Based Targets Initiative has just come up with some guidance on the appropriate use of offsets. And I think this is an area, like we alluded to earlier, that will need increased standardization on what is the appropriate use of offsets. And the UNFCCC's Race to Zero is currently consulting on this now. So it'd be interesting to see where they land.
I think that's a good place to bring this to an end. I want to be respectful of your time. Alex, I know you have a wedding to attend. Thank you very much, guys. This has been an incredible conversation. Really cool to go into the weeds with such great thinkers on this topic. So thank you for dropping by, and have a good day.
Thank you.
Thank you.